now that we have talked a little bit about the basic principles behind an internal control policies, internal control system, and some of the things that need to be there, we're going to really talk about this as it applies to cash to demonstrate, because cash is the most susceptible asset to fraudulent activities. Because of the large volume of cash transactions, numerous errors may occur in executing and recording them. To safeguard cash and ensure the accuracy of the accounting records for cash, effective internal controls over cash are absolutely critical. So let's look at some cash receipt controls. This is the application of the control activities to the receipt of cash, starting with the establishment of responsibility. So only designated personnel should be authorized to handle cash receipts. So for example, cashiers are assigned to specific drawers. There should be a segregation of duties, meaning that different individuals will receive the cash versus recording the cash receipts and then holding the cash. So the cashier receives the cash. The reports on that cash go to an accountant who records the cash receipts and verifies that the reports from the vault handler who holds the cash match that of the cashier, and that also serves as an independent internal verification. There should be document procedures in place, so there should be a remittance advice for things like mailed receipts, your cash register tapes, deposit slips. All of these things should be in place in relationship to cash. Personnel who are handling large volumes of cash should be bonded, and those employees should be required to take vacations, and background checks should be carried out. Supervisors should count the cash receipts daily and assist the treasurer in comparing the total receipts to the bank deposits daily. Now let's talk about over-the-counter receipts. In retail businesses, cash registers are used, which are visible to the customers for the receipt of cash. The control activities of over-the-counter receipts are that a customer receives an itemized receipt and is expected to count the change received. The cash register's tape is locked in the register until a supervisor removes it. Nowadays, it's largely electronic. At the end of the clerk's shift, the clerk counts the cash and then prepares a deposit slip for accounting to account for that cash. The clerk sends the cash and that deposit slip to the accounting department. The supervisor removes the tape or pulls the report and sends it to the accounting department. The accounting department checks that the register's tape and the deposit slip agree. So this could just be all the cash is put into an envelope and the amounts written on it. Depends upon the organization. When we say deposit slip, that doesn't necessarily mean a deposit slip to the bank per se. It could be a deposit to the vault. In some instances, the amount that's deposited at the bank will not agree with the cash that's recorded in the accounting records based on the cash register tape. When such a difference occurs between the actual cash and the amount reported on the cash register tape, we use this account that's called cash over or short for accounting purposes. Let's assume, for example, that the cash register tape indicated sales of $6,956.20. But the amount of cash that was received was $6,946.10. There is a cash shortfall of $10.10. So the entry we would use to record this is we would have a debit for the cash amount of $6,946.10. We would debit the account cash over and short, $10.10. Unrecognized sales revenue is $6,956.20. When there are discrepancies between the report and the actual cash that is received, sometimes it is just human error. Somebody gave a 20 instead of a 10, didn't give out the right change, something along those lines. However, frequent and regular cash shortfalls attached to a specific cashier would be investigated, and any significant shortfall would be investigated. So let's talk about mail receipts. So this is when there is payments that are mailed in. When those are received, they should actually be opened in the presence of two people. They should be immediately endorsed for deposit only. The clerks should prepare in triplicate a list of the checks that were received each day. Both clerks should actually sign or initial the list. An original copy should go to the cashier's department, and then a copy is sent to the accounting department. The third copy of the list is kept by the clerks. Now, nowadays, we don't have as many mail receipts as we did because most people are now utilizing other means of paying, such as EFT, credit cards, and so forth. However, if you are working for a very large organization, manufacturing or a large merchandising organization, you may encounter this. This is a suggested list of how this should occur. Not always is this how this occurs, because some people have other steps that they may infer in here, or they may have a slight variation. Know that these different controls that we talk to you about are the suggested controls. They are not the only things there are. So now let's talk about cash disbursement. This is the payout of cash. So cash is dispersed to pay expenses and liabilities or to purchase assets. Internal controls over our cash disbursements is more effective when payments are made by checks or electronic funds transfers rather than by actual cash. Now, there are incidental amounts that may be paid out in cash, and that is things like the petty cash fund. Now, why would internal controls be more effective if we're using a check rather than cash? Think about that for just a moment. Checks create a paper trail. They have a checks and balances system to them. One person is writing them, another person is doing the bank reconciliation. It's much more difficult to engage in fraud when a check is in place. So let's look at cash disbursement controls. So there should be an establishment or responsibility of only designated personnel are authorized to sign checks and approve vendors. Different individuals should approve and make the payments. Check signers do not record the actual disbursements, so that there's a segregation of duties. Should use pre-numbered checks and account for them in sequence. Each check must have an approved invoice. Require employees to use corporate credit cards for reimbursement expenses potentially. and stamp your invoices paid. This keeps them from running back through the system. Now, there are several computerized accounting information systems, accounting systems, that if you use the same invoice number for the same vendor more than once, will flag that or will not allow you to save it. That is not the case with all of them, but just so you know, that if you are working in a data entry bookkeeping type of maybe accounts payable position, how and why that may happen. There should be a physical control on the blank check stock where it is stored in a safe or a location with limited access. Checks could be printed by machines in what's called indelible ink, which is a special type of ink. Checks should be compared to the invoices before they're signed, and bank statements should be reconciled monthly. Individuals who are handling cash should be bonded, and employees that have access to cash should be required to take vacations and should have background checks conducted upon them. Now we're going to talk about a voucher system here. That's a network of approvals by authorized individuals that act independently to ensure that all disbursements by check are proper. A voucher is an authorization form that is prepared for each disbursement. So some of the steps in a voucher system would include preparing a voucher from the vendor's invoice. An employee in accounts payable would record the voucher in a voucher register and file it according to the date on which it is to be paid. A check would be issued on that date, and they would stamp the voucher paid. The paid voucher would then be sent to the accounting department for recording in the check register. A voucher system is effective because it establishes responsibility for the authorization process, keeps track of documents that back up the transactions, and is something that is probably in place with very large companies. You're not going to find a voucher system when you're thinking about a small business, just because there's so many steps in that they usually have taken the authorization portion of the voucher system and integrated it into their system in a different manner. So honestly, there is a lot of fraud that really does occur every day. And that's occupational fraud, and using your occupation for personal gain through the misuse or the misapplication of companies' resources or assets. So for example, asset misappropriation, which would be the theft of cash on hand, fraudulent disbursements, false refunds, ghost employees, personal purchases, and fictitious employees. While this fraud is the most common, it is also the least costly. Now, when an instance of corruption occurs, such as bribery, illegal gratuities, and economic extortion, this fraud generally falls in between asset misappropriation and financial statement fraud as regards to how often it occurs and then the costs that are associated with it. Things like financial statement fraud are a little bit more intense. This is things like fictitious revenues, concealed liabilities and expenses, improper disclosures, improper asset values. This does occur less frequently than the other types of frauds, but it's typically much more costly. The amounts are much larger. So let's just take a minute and look at this graph. which shows the frequency and the median loss for each type of occupational fraud. This should illustrate to you how important an effective system of internal controls is.